Welcome to our First Home Buyers Seminar, and congratulations, you've just made the first step in purchasing your first home. We'll be covering the following in the seminar. First of all, getting the bank to say yes. We'll then talk about the bank of mum and dad, which is guarantors, any exemptions to the LVR restrictions, how you go about buying a home, the buying process, sorting out your KiwiSaver and Home Start grant, are you eligible, how much can you get, any insurance that you might need on the property, the house, any contents insurance, life insurance, trauma and income protection insurance, and then a bit of a selfless promotion about myself and what I do for you guys and how I make it all happen. Then we're going to have a lawyer speak, give you a bit of information about some of the legals. And last but not least, we'll have a building inspector have a bit of a chat about what you need to look at in a property and the potential pitfalls. The most important thing is we get the bank to say yes. We need to look at your collateral, your capacity, and your character. One of the most important factors is how much deposit do you have? Are you a 95% borrower, 90% borrower, 80%? How much collateral or deposit do you have? Secondly, we have the capacity. So how much income's coming through the door on a weekly, fortnightly, or monthly basis? How much do you have as usable income after you've paid for your expenses? And then the third one, which is extremely important, is your character. So how you look on paper. Do you have unarranged overdraft fees? Have you been in overdraft for 150 days of the last 365? You need to look like the best possible version of yourself when we put an application through to the bank. If we look at the LVR restrictions, the Reserve Bank came out and said every client needs to have 20% equity to purchase a home. But there are provisions to allow you to purchase with only 10% deposit. However, only 20% of the whole of the bank's lending can be for someone over 80%. So there's a shorter amount of money available for any applicant that's borrowing over 80% of the purchase price. Doesn't mean that you can't buy, it just means there's less money available. Unfortunately, when you borrow over 80%, the bank don't come screaming at us with some incredible interest rates. You typically pay higher interest rates. You'll also have to pay for a valuation to make sure that you're not purchasing for more than what that property's value really is. As a 90% or over 80% borrower, it's also quite tricky to get a pre-approval in place. Typically, the bank would like you to purchase a property subject to finance, and we would ask you to have a 10-day finance condition, just so we have enough time to tick off the valuation, the finance, and any other conditions. The best offer is going to be the bank that actually says yes. Of course, we want to get you the lowest interest rates possible. We want to do everything we can to get you a bit more cash, but we need to make sure in the end that you can purchase your first home. When we talk about guarantors, we're not talking about money moving from one place to another. There's no gift involved. Mum and dad don't have to take out cash from one bank account and move it into yours. All we're doing is sharing the equity from their property onto yours to make sure that you have 20%. It's a common misconception and a big thing that says that parents don't want to get involved in this because they literally think they're going to have to give you some cash. If you purchase a property for $500,000 and you only have $10,000 deposit, which is a lot of money, $50K, then the guarantor is clearly going to be $50,000 from your parents. Your loan will be $450,000, but the guarantor will be $50K. So effectively, the bank is just saying that if they have to, and you stop paying your mortgage repayments and they have to sell your property, then they can request that your parents take out a $50,000 mortgage against their property. Now, in doing this, we need to prove to the bank that your parents can actually afford to pay back that $50,000. But you also need to put that over a shorter term of, say, 10 years, because typically your parents are going to be a little bit older than you, and their work-life existence is probably a little bit smaller. Capacity is your ability to pay the mortgage. We need to ensure that after all of your expenses that you can actually afford the home that you're going to live in, but also the rates that the property has. We also need to consider the insurance that you have to have. It's mandatory to have insurance on your property. And all the other costs that come into play when you actually own the property. They want to make sure that you can afford it, so it is the bank's discretion as to whether they approve the loan. Every bank looks at a client in a different way. That's why it's extremely important to talk to me, because I know what you look like on paper and I can direct your application in the right place. So we need to consider which bank is your application going to go to. If you're buying your first home and you have 20% equity, great. Then you'll be subject to the standard pass marks, or they call it uncommitted monthly income. If you're buying over 80% of the purchase price, 90% or 95%, then you're going to have a stronger pass mark than someone that's buying 80%. This is a prime example of not all banks are the same, and you need to make sure you put yourself in a position where you have the option for all of the banks. We're moving on to character. If you put yourselves in the position of maybe a credit assessor at a bank, looking at the risk of them lending you the money, they're going to take into a number of factors. First of all, how long have you been living in the property that you are in currently? How long have you been in the same employment? Really important portion is, how do you guys look inside your bank accounts? Have you been saving any money? Have you been in an unarranged overdraft? Have you been in overdraft for a long period of time? You got to think, what are they going to see? Are they going to see McDonald's, Burger King, Liquorland, Liquor King, Soul Bar, all these other places, but no savings? You want to make sure that the difference between your rent payment that you're paying now and your potential mortgage repayments are matching up. So if there's a difference between the two, you're going to make sure that you're at least saving that difference to show that you can afford to pay for that mortgage. Let's have a quick look at what you can expect at the different equity levels, or how much deposit you have. 20% deposit, 15% deposit, and 10% deposit. If you have 20% or more equity, it's pretty clear that the bank's going to come to you guys with sharp interest rates. They're probably going to give you a professional fee, or what we call a cash contribution, and that's always a percentage of what you borrow. Some banks offer more, some are obviously a little bit less. But most of all important is it's quite a fast process. You're going to get a pre-approval, and you don't have to pay for a valuation fee as well. So you're going to save yourself $750 to $1,000. When you're borrowing 85% of the purchase price, you'll get pretty good interest rates, but not as good as if you have 20%. You'll also get a cash contribution, but it's not going to be significant like 20%. So you'll get something for your solicitor's fees, but you're actually going to have to pay for a valuation. So that valuation is going to cost you $700 to $1,000, depending on where you are, how big the house is. If you're borrowing 90% of the purchase price, unfortunately, the bank's going to price that accordingly. Because there's a bit more risk involved, then you're going to end up with interest rates at the higher 4s and most likely into the 5s. You're also going to have to pay for that valuation. When you're borrowing 90%, the bank is generally going to add a low equity premium. So your interest rates that you get might be, say, 4.79, but they might add 0.75% interest as that low equity premium. Some banks will charge a low equity fee. So this will be a percentage of what you borrow. Now we're on to the Reserve Bank's exemptions to any of the restrictions that they've put in place. As a first home buyer, we need to consider Kiwi build and affordable housing. Now, if you're buying a first home, then you're only required to have 10% deposit. It does come with higher interest rates, but it means that it's much more available money. The banks have those provisions in place, so at any stage they can lend to you based on a new home at 10%. There's two types of construction contracts, and they vary in small ways. There's a turnkey, which is you pay 10% deposit up front, and then you pay the balance on completion. That's really straightforward and probably a preferred method through the bank. The other option is to buy a section and have a fixed price contract. The problem with this is you're going to have to pay your mortgage at that particular period of time, depending on how far through the process you are and how much you've drawn down on your mortgage, plus we have to factor in your rental costs at the same time. Auckland is churning out a lot of property at the moment, and the projections are to have that many more. I know developers that have over 100 properties being released to the market in the next 12 months. So a first home as a brand new home is very achievable. Okay, let's go over the buying process. One of the most important things is to actually stick to your budget. From our first appointment, I would have told you exactly where you were positioned, what your maximum purchase prices based off either your income or your deposit level. You need to research the infrastructure, the weather, what's happening in the area. Is this going to be a good investment? Is this actually the value of the property that I should purchase for? As a first home buyer, it's quite important that if we can actually get you a pre-approval, then we're actually going to get you pre-approved to your absolute maximum buying power. This is not vulturism, but it's more so getting you guys in a position where instead of you coming back to me in 2 weeks' time and saying, man, we've looked for a home in that price bracket, but we just can't find one. Can you get us a pre-approval for a higher amount? We've already done that. It's not about spending as much money as you can, but it's about putting a pre-approval in place that allows you to purchase a property that you want to purchase and something that's realistic. How do you purchase? Are you going to purchase by negotiation, tender, deadline sale, or auction? There's some really important things to consider when you're taking on these different purchasing methods. If it's by negotiation, no drama whatsoever. Have a finance condition in there. We need to make sure that you tick off the valuation, building inspection, and what other conditions you have. Clearly finance. Tender or deadline. Tender, you generally want to put your best foot forward. You want to make sure that your offer is as clean as possible. And then last but not least, auction. This is difficult. The market is so competitive. And as a 90% borrower, you're going to have to go in prior to the auction and get the valuation done on that property. Now, if there's a lot of competition in that property, you might go and spend that $750 to $1,000 on a valuation, but there's a lot of other people that don't have to do that, and they spend maybe $2,000 more than what your top bid is. That's going to frustrate you, especially if you've gone to 10 different properties. You're not going to spend 10 times 700, $7,000 on valuations. So you need to make smart decisions about the properties that you're going to go to. Legal advice. This is a huge part of the purchasing process. You need to make sure the solicitor has had a look at the property, has made sure that the property hasn't had any unauthorized works done to it or any unconsented work. Make sure that it's not in a flood plan, and check to make sure that it has a clear title. The banks are really sticky on whether the property has unconsented work or a defective title. We need to make sure that this is all okay before you purchase. If you go unconditional on a property and it does have any unconsented work or the title is defective, the bank could effectively say, we're not interested in this property, we're not going to give you the money to settle in the house. That's a really awkward position. Conditional versus unconditional. I'm not sure if this is as obvious for you as it is for me, but conditional means that you have conditions in place. Unconditional means you don't. The problem is if you go unconditional on a property and you don't have an unconditional loan offer, they might not give you the money. Once again, that's awkward and not a nice situation to be in. So you need to make really good decisions. Basically, you just need to call me when you're looking to make an offer on the property. Let's do some finance conditions. You might have a meth test, building, whatever. Let's make sure that you're making good decisions. Last but not least, and a really important one, is emotion and pressure. I can tell you now, when I bought my first home, I wasn't overly emotional, but my wife really was. And she definitely added pressure to the situation. She found a house within 3 days of being pre-approved, and she was set on purchasing that property. So emotion was involved, and hell yes, there was some pressure. We managed to put ourselves in a position where we could turn up to that auction. It went to a pre-auction offer situation, so we had to get everything sorted really quickly. We went out there, and thankfully we had $1,000 more than the next person. But it's really important to take a step back from time to time and make sure you're making a good decision, because a good decision in property is great. A bad decision is horrible. Really importantly, we need to be making sure that you're offering what the market rate is for that property and not over that. If you've got 20% of the purchase price, then you're probably all right. You don't need a valuation. But if you have less than that, then you can need that valuation, and your purchase price needs to be accurate to the market. How do we check out to see whether it's accurate? There's a few websites. Clearly homes.co.nz is something available for you. You need to consider the CV or the rateable value of the property. This is kind of a little bit out there at the moment. A couple of years ago, it was 50% of what the actual purchase price was likely to be. So far off. But at the moment, it could be higher, it could be lower. So realistically, I would be asking myself to do a current market analysis against what the other properties on the market are selling for at the moment, what's on the market that has the same kind of caliber, 3 bedrooms, 1 bathroom, 400 square meter section. We can check to see and make sure that you're not going to be offering over the odds. The other thing to consider is, would you be upset if the property sold for $5,000 more, or do you think you should spend that extra $1,000? If it's pre-approved, would you be upset if you lost the property because you literally didn't go that $1,000 higher? So as long as we're working within the parameters that you've been approved to, just take that into consideration. The final point is the negotiation process. There's quite a few different steps to this. Firstly, settlement date. When are you going to settle? If you're light on how much you're going to offer, you might want to make your settlement date closer. We need to do this in a realistic time frame. How long do you need for finance condition? You might want to shorten it up as much as possible. How much deposit are you going to pay once you've secured the property? If all of your money is in KiwiSaver, then it's probably great if you have a condition to mention that your deposit's payable on release of your KiwiSaver, and get as unconditional as possible, assuming you've ticked off all those boxes. Yesterday I had delivered a box of Cookie Time cookies and a bottle of wine from a real estate agent because I put my clients in an unconditional situation, even though they were borrowing over 80%. And it meant that those clients could commit to that property and they were rewarded with the contract. So guess who is moving into their first home in the new year? My client. KiwiSaver has been extremely instrumental in helping thousands of Kiwis get into their first home. There's a few things for us to consider. Firstly, have you been contributing to KiwiSaver for a period of at least 3 years? You can't take that first $1,000 that the government put in as the kicker. You need to obtain a KiwiSaver withdrawal quote from your KiwiSaver fund manager. Now, this is a conversation that you just need to call them up and have. And the trick is to make sure that they email it to you, because generally they try to send it out in post. And to be fair, how many of us use post these days? It'd take about a day to 2 days for them to send it through. So make sure that when we meet up, that you have this available so we can get it all into the bank and then get you a loan offer that doesn't have a whole bunch of conditions. You need to make sure that the solicitor that you work with is going to allow you to withdraw your KiwiSaver for deposit purposes. A lot of solicitors won't do that because it's a bit of a nightmare for them. Get them in, get them proactive, and make sure that they work nice and smoothly for you. Your KiwiSaver withdrawal quote is enough for the bank to be happy, but you can't get formally approved for your KiwiSaver until you have an unconditional contract. This is part of the process of signing your documents with the lawyer. They'll get you in to make sure that you get that withdrawal done nice and quickly. Accessing your KiwiSaver as a deposit, you can do it, but it's not simple. And typically a deposit on a property, they want you to pay within 24 hours or 48 hours of actually going unconditional. So you need to either have a condition in to allow you to pay KiwiSaver as deposit once it's been released, or we arrange an overdraft for you. Let's bear in mind if this overdraft is unsecured, then you're going to pay 19% on that overdraft for say 30 days until your property settles. Your KiwiSaver withdrawal is all done through your solicitor, just part of their paper. But most importantly, if you want to buy a home, 8% is the maximum you can contribute. Make sure that you move your KiwiSaver contributions up to 8%. This is going to be a huge factor in telling us how long it's going to be until you can purchase your first home. So increase it to 8%. So you've saved some cash, you have your KiwiSaver performing quite nicely. But how about we get the Home Start Grant? If the government's handing out cash, let's grab it. So we need to take into consideration how much income do you have and how much are you going to be eligible for. Income, if you're a single person buying a house, can be $85,000. If you're a couple or 2 people purchasing a home together, maximum income is $130,000. Now, if we look at how much the government is going to give us as our Home Start Grant, if you're a single person borrowing, it's $1,000 per year that you've been contributing up to 5 years, so $5,000 for an existing house. But if you're purchasing a brand new home, it's $2,000 per year, so 10 grand. Double that if you're a couple. The toughest thing is finding houses that are going to fit into the category. So as an existing house, you can purchase to a maximum of $600,000. If you're buying a new home, that's $650,000. So we're not talking about huge money for a brand new home. You need to consider, where are you going to purchase? The pre-approval for your Home Start grant lasts for 6 months. So you need to consider also, when are you going to apply for it, because you want to make sure that it's still valid when you purchase a home. When you go through the application process, you'll need to go online and put the application through. It's generally the easiest way to do it. To get a pre-approval takes a minimum of 10 working days. So if you're in a sale and purchase agreement and you're still waiting for your Home Start grant approval, you're going to need at least 10 days as your finance condition. To allow me to work efficiently for my clients, we need all the information up front. So when we have our appointment, it's great if you turn up with your KiwiSaver withdrawal quote, your pay slips, your bank statements, and anything else that I've asked for. Maybe your IRD login, so that we can get the information of your last 2 years' income. Especially if you're a commission earner and your salary might be lower, but you make quite good money. It's really important to turn up with all the info. Once we've all kicked some butt and you've purchased your first home, then we need to consider the structure of your mortgage, what your interest rate's going to be, and so on. I would have already told you and given you an indication of what you can expect out of interest rates, so we don't find you in a situation where you expect 4%, but realistically it's 5.3%. We go over that all from the very beginning. Pricing is all dependent on how much equity you have. You're a young couple, you're growing, you're doing your thing, you've got some finance on a vehicle, it's not a problem. But sometimes we need to pay off that finance and reduce your deposit to get you into a property. Sometimes we need to refinance that, put it over a longer term, spread the payments out, reduce your cost per month, and then we can also get you in a property. Sometimes we need to reduce a credit card limit, because the bank doesn't calculate your credit card costs as of what you owe on that day. You only might owe $50. They calculate your monthly expense based on 3% of whatever that total limit is. If you've got a 10 grand credit card, you could go out any day and spend that on fishing equipment like I would, maybe not 10 grand, or you might buy a handbag, you might buy whatever you like to do. So that's going to add $300 per month to your expense column. So in that situation, we get you to lower your credit card limit and boom, you can borrow more. We need to make sure that we insure our assets. And when we call our assets a house, a car, a boat, whatever it is, some jewelry, that's great. But a lot of people forget about what their number one asset is, and that's ourselves, right? So you go into purchasing a property, but you don't have yourself insured. What's going to happen for your partner, your wife, your husband, whatever they are, and your children, if you are incapacitated, you can't work, or the horrible thing happens, which you do, pass away. So we need to make sure that you actually have some life insurance. We don't need the Rolls Royce of life insurance, but we need to look at what our debt levels are. We need to have adequate insurance to ensure that if we can't work, then we can still pay our mortgage, we can still have McDonald's if we want McDonald's, and we can continue life on as it was. It doesn't have to be extremely expensive, but to not have some life insurance is probably being a bit naive. You must have house insurance. You cannot get away with having a mortgage without house insurance. When you go to settle your property and you sign your mortgage documents with your solicitor, the solicitor is also going to send proof of your insurance. They call it a certificate of currency or a certificate of insurance. The bank won't actually draw down the money for you to settle on your property unless you give them that insurance. And also, why would you not have house insurance if you have property, right? If you've got a $500,000 debt over a property and then your house burns down, how are you going to repay that debt? Pretty horrible situation. Insure your cars, insure everything, make sure you got it covered. A really important cog in the wheel when you're purchasing a property is aligning yourself with a really good, effective, and good communicating solicitor or lawyer. I've got Ross Sly here from Galbraiths, and we're going to ask a few questions about what you need to be doing when you're purchasing a property. So the first of this is, we've been asked about a land information memorandum, or everyone calls them LIM. Is this necessary? And what are you going to do when you're looking at this, mate?
Well, it's absolutely necessary in most cases. In most cases, either it'll be available through your real estate agent before you go to auction or through the marketing, or we can get that for you on your behalf.
Cool. And what are you looking at in that limb?
A limb will tell you things like building consent history, building permits. It'll tell you information around surrounding properties, things like contamination, zoning information for the property.
Yeah, cool. And do you have many property transactions, fall apart or collapse because of a limb clause? Or?
You can do, where perhaps it gives information on proposed developments nearby, history of properties, perhaps it's formerly been a contaminated site. It may provide information around zoning where it goes against people's long-term plans for the property, i.e. subdivision.
Cool.
In Auckland at least, we don't ordinarily get the building plans for your house as part of the LIM. So we can and often do recommend people get the building plans or property file, and that's a separate item that we order from council.
Yeah.
And that allows clients who, as a lawyer, I've never been to the property, but clients to compare their mental walkthrough of the property against these plans. And if we find walls are missing or there's alterations, they can't piece the plans together with what they saw.
Because a LIM's a shortened version of a property file, right?
It is, but it's an assembled report. The way I like to think about it is a property file is every bit of paper specific to the property. A LIM does contain information about the property, but it also contains information about the broader area, so the surrounding house. So if they're going to put a prison 500 metres down the road, and that's an extreme example, you're going to find out about that. You won't see that in the property file.
Correct, yeah, cool. Good point. So we've had Grant here as a building inspector, and as a solicitor, what's your kind of recommendations around having a building inspection done? Do it, don't do it, what are we talking?
Sometimes because of perhaps timelines, it's difficult, i.e. clients are racing to an auction and there just isn't the time. But it starts on the list. Where maybe you don't get it, it's still worth consulting with your lawyer as to whether to get it, if you know what I mean. Where you're buying off the plans, clearly...
Like a new co-compliance certificate.
Or a brand, that. Or even if it's not a deal breaker for you, it's just an awareness thing.
Knowing about the property and so on. And it also, clearly, a bad mistake in real estate's a bad mistake. So if you have to spend $500 to get a report done, then you're probably better off doing that than $20,000.
And you get both sides of it. You get people who get a builder's report and it doesn't raise things that lead them to pull out of the deal, but maybe the builder's saying, it's slightly cheaply built. But you also get people who go for the builder's report and the feedback is, well, this is a really, well-built home. Or it's been, it's going to stand the test of time. And people actually, for spending that $500, they've got this real comfort going forward.
True. And if you think about the likes of replacing a door handle, not a big deal. You can do that for $20.
Correct.
But if it's a hot water cylinder like we've spoken about before, they can cost a couple grand depending on what it is, or go even further than that in the posts for a home or the piles.
And it does also feed in a little bit with what we talked about with limbs. To the untrained eye, you might not pick up to possible unauthorised works that you, which is why we look at the building plans. A building inspector in doing a building report will probably trigger that sort of stuff or elements of possible non-compliance.
Yeah, cool.
Not just the quality of the building, but legality points.
I think we've kind of clearly covered off that a building inspection is a pretty necessary thing, but also meth testing.
Yeah.
That can come with a building check as well. Most of the building inspectors will generally have a swab kit. But it's unfortunately it's pretty prevalent in New Zealand's culture, or not culture, but in our society. So we need to consider that, right?
Correct. With real estate agents, whether you read it or not, they should be bringing it to your attention on their little checklist when you're making an offer. It'll be on there somewhere. They'll probably raise it with you verbally. Again, like a builder's report, it's sort of how I put it is it starts on the list. We need to find a reason to take it off the list. So intimate knowledge of the property or perhaps the owners might justify it. New build, but even then, that's just low risk. It doesn't mean no risk. Contractors could be smoking. You get extreme examples, but it's a case by case, but it starts on the list.
Of course, I'm going to say this, but most important part to this part with Ross is the finance. Okay, so One thing that's great is I work a lot with Ross, and assuming you give the approval for us to talk about your situation, then we can also communicate in that manner. So it makes things really easy, got a good working relationship. But the conditions are you chuck in a building inspection, LIM and so on, but finance is clearly going to be a condition in a lot of situations, especially if you're a 90% borrower. So, Ross, I always generally give 10 working days as a finance condition for my 90% borrowers. So is it, I think it's 10 and 10 working days now for...
Yeah. In terms of application process to get your okay through, and then actually getting the money out of the provider is another 10 in a lot of cases. That's what they say. KiwiSaver providers, your Westpacs, your AMPs, your ANZs, they tend to come in well within that. The biggest thing is time is our friend with these things. And the sooner we get your paperwork done and off, the better.
Cool. So you might answer this for me. It is actually possible to use your KiwiSaver funds as deposit?
Yep. So it's good to know that up front. So when I meet clients or talk to them initially after a referral, it's just a really simple question. I just say, how are you paying for this? How do we make it up?
Yeah.
So how much is borrowed from the bank? How much is KiwiSaver withdrawal? How much is cash? How are you using?
Well, basically, how are you going to settle on the property?
The whole lot, because all the other stuff, limbs, builders, it's a bit superfluous if you can't
pay for it.
And then we figure out what we need to do practically and when. So, for example, if you are relying on KiwiSaver withdrawals to fund your deposit, then we need to be on top of that. Maybe immediately. Get those forms in.
Yeah.
Where we know you can pay a 10% deposit in cash, or the 5% deposit you've agreed out of cash funds, then we know we're only going to be withdrawing your KiwiSaver funds for settlement.
Cool. Okay, so that's pretty much the finance piece. We just need to make sure that we work within the timelines that KiwiSaver, Housing New Zealand, Home Start Grant allow us, and clearly the banks, we need to get some money from the banks. So that's the finance piece. So the last part to me working with Ross on this occasion is the title and insurance. So clearly you have to have insurance on the property and then the title. So Ross, you do some checks on the title. What is it that you're really checking?
Okay, well there's two scenarios. The first is if you're going to auction, we need to have entirely approved and checked that title before you go, because there's no out if you win that auction. So often the title documents will be available through the real estate marketing pack. We're looking at the title land covenants. So those are rights on the title that restrict what you can do on the land that are enforceable by neighbours, for example.
That might be if it's cross-lease, right?
Correct, or if it's cross-lease, the type of title, is it body corporate? And really what we're communicating with you is, what are your plans, expectations, and is there anything on that title that's going to inhibit that? I.e., if you're buying a cross-lease property, there's limitations on your ability to develop that property beyond maybe a freehold property.
Extend out.
Yeah. So you need to know that. If it's got no development potential by virtue of the type of title, we need to tell you that. If it's got restrictions on it, meaning you could only ever be at one level, we need to tell you that.
Sure.
Sometimes you can get land covenants that say you can't, even though they're under the new subdivision restrictions, from a council point of view, you can subdivide, but neighbours, by virtue of the land covenants, might be able to stop you subdividing. The ability to have a minor dwelling, again, neighbours might be able to stop you doing it, that sort of stuff.
Yeah, cool. So clear title, it depends on what type of title it is, whether it's freehold property, leasehold, cross-lease. So we need to consider that. And then lastly, house insurance. Clearly we've been through this already, but if you have an investment in a property, you've got a debt towards that, 500K, the house burns down, you're in a bit of strife, right? So when we go through this process, I always refer my clients through to an insurer. The insurer will then give the client a certificate of insurance or a certificate of currency. Then it's the client to pass it on to Ross. And then Ross, as part of your document pack, you'll pass that back to the bank, right?
Correct. And with the insurance, there's a few things there. I'm ultimately only providing it to the bank at the very end, but sometimes because of the nature of the property, it'll be something that comes up for me much earlier before you go unconditional, and probably in the finance space, Ryan will be across that. And that is where a property that's early 1900s, an old villa, where maybe the wiring or features of the property, the foundations might go to insurability. We want to establish insurability really early.
Yeah.
So that's your classic, Kingsland 1905 villa.
Yeah.
Or properties in Kaikoura, Nelson, Wellington, that were affected by the earthquake. Sometimes that issue can come up as well.
Yeah, cool. So it's quite common for us to come up with a property in New Zealand because we're a country of renovators, generally without too much style or ability, but we need to make sure that if there's any unconsented works, then it's all been ticked off with a safe and sanitary report or a certificate of acceptance.
Yep.
Otherwise, we can have serious problems when it comes time to settling. They literally can't have the ability to not settle on the property. So that's a real big part of it. Insurance, got to have it. Thanks for coming along today. If you're considering purchasing a property, which you clearly are, Ross is a great man to talk to. So you're now pre-approved to purchase a home. You go out there and you're conditional on a contract, but you're going to want to have a building inspection to make sure that the house is good. So I've brought in Grant Tibbetts here from the property inspectors. We're going to ask him a couple of questions about exactly what he does and a few other parts. So Grant, what is it that you do, mate?
Well, basically, I go out there and give a condition report on the condition of the house. So basically, you know what you're getting, age, what it's made out of, what kind of insulation it's got, does it have any issues, does it have any major issues?
Clearly problems we want to know about.
Exactly. I mean, for example, how old is the hot water cylinder? It could be 30 years old and you're going to be out for a couple of grand if that kind of fails in the next year or so, which is a couple of $1,000 that you're going to have to come up with.
Yeah. One of the big things that's quite important is, who do you work for?
I'm working for my client. I'm working in their best interest so that they know what they're getting.
So Grant's not here to kill a deal, but you're employing Grant to make sure that the property that you want to purchase isn't going to fall down in 6 months, right? So it's a really key thing to understand. He's not the enemy. He's actually the man that could be saving you from falling off the cliff. What does it cost for a general inspection?
Look, costs can vary. If you can appreciate the houses are, size and complexity, they all range. So they average out about $450 plus GST, right up to a couple of $1,000 and more depending on how big they are. So generally speaking, for the average 3-bedroom house, $450, $475 plus GST.
Yeah, cool. So depending on size, nature of the property, potential issues, and la-di-da-di-da. Cool. And what are the things to look for as a first-time buyer? What kind of properties should we be looking for, staying away from? What do we need to consider?
I suppose it's like anything. You need to have a house that fits the purpose for a start. So there's no sense looking at something that's not going to fit your purpose. Obviously people want to get on the property ladder, so they're looking at anything and everything. So obviously design and age of the house can have a great effect, and location as to where you might be living in Waiuku, but you work in the city, so might be a cheaper house, but you're going to be paying a lot more in fuel to get to work.
Yeah, cool. So clearly the structure of the property is one of the biggest things we need to consider. If you're buying with less equity, then you might want to consider, do we buy a property that might be up for more maintenance, or do we keep away from plaster buildings? Plaster has got a really bad rap in New Zealand, so stay away.
Well, hey, look, here's the thing with anything. Every product has its pluses and minuses, and it comes down to what era it was constructed. The thing about houses, they're a bit like cars, they're always improving with age. So obviously the more modern house you can buy, the more the building code would have changed, so that it's a safer house, to buy. So obviously it's just like buying a car or buying anything. If you can buy a newer house, then do that.
Yeah. Cool. Okay, so we've got the nitty gritty. Make sure that you're purchasing a property that's fit for purpose. It's not going to fall down in a short period of time. And then also the maintenance, the things like the hot water cylinders and so on. What are these going to cost you in the short term? They're not terribly problematic, but you need to consider, do you have money to fix that in the next 6 months if that has shown up in the report, right?
For example, even just painting your house could cost you, if it's a 2-level house, you're going to have to scaffold it maybe. Yep. It's going to cost, so you just got to factor those things.
Cool. Make good decisions, guys. Grant's here, ready to work for you guys. And remember, it is you that is the client, and he works for you. Now that you have all this information, you might be asking, well, I've got it all now. Why use a mortgage advisor? Well, clearly I have access to every bank in New Zealand. So you want to make sure that you guys are being put in the right direction. There's no point turning up to your bank and asking for the goods if you don't fit their profile for a mortgage. Day-to-day banking is absolutely fine, but you need to make sure that you look great to them. If there's a better bank for you, then we must send you in the right direction. So we'll get you into the bank that's perfect for your situation. My guess is you're probably thinking, oh great, how much do we have to pay this guy for this service? It's free of charge. My service isn't free, I get paid by the bank. And they pay me because they know that I'm going to help you settle your loan. It's one less staff that they have to employ, and I do a great job, and I specialize in first home buyers as well. So make sure that you give me a call because I know which bank's going to be perfect for you. You don't have to pay me a cent. Don't mistake this as arrogance, this is confidence because I know what I'm doing. If you're going to buy a first home, I'm the person to speak to. I specialize in first home buyers, and I love getting that kick out of when my clients buy a home. You can feel my passion, pick up the phone and give me a call. We're going to make it all happen for you.